And of course, this is a time where I think everyone really is focused on the economic conditions out there, whether the economic conditions are resilient enough to withstand an increase in inflation, whether it's resilient enough to withstand, I guess, the antidote to that inflation, which is going to be Fed rate hikes.
No, you're absolutely right. And one of the wonderful things about having everybody back here at Milken is you get the global context. And I would say my biggest impression from this morning has been just how different things are around the world. We talk a lot about the U.S., but in China we actually have slowing growth and a central bank that is easing. In Japan we have no inflation. We have a central bank that would like to have inflation. In Europe we actually have slowing growth, and I would say we're a couple of sanctions away from maybe even tipping into a recession, and the ECB also dealing with high inflation. And here in the U.S., obviously, we've got a robust economy. We have high inflation, and we have a Fed that said they're going to be very aggressive. But, for the last 10 years, we've all been largely in sync. And for the first time, there's huge regional differences now in the economic outlook.
Does that lack of synchronization, does it bother you? Does it worry you?
It doesn't worry me so much, but I think it does change the way you view your portfolio. I mean, all of a sudden, actual country and currencies matter a lot more than they have over the last couple of years, where I think there was a real dominance of what sector and industry are you in. All of a sudden now, being in Europe is a tough place to be.
What about here in the U.S.? Do you buy in this environment? Do you hedge in this environment? What do you do?
One of the interesting things in the U.S. is that different markets are really telling you different things about the economy. So if you look at the bond market, clearly with the recent inversions and the rising rates, you can see that the bond market believes that there's a significant possibility of a recession probably in 24. The equity markets, at least until April, I would say, are saying soft landing, don't worry about it, the Fed will be able to manage this. Meanwhile, we look at the private markets, particularly real estate, and it's never been busier. I mean, whether it's transactions or prices are rising, and we can raise money easily for it because it's an inflation hedge.
Right.
So you're getting very different signals right now from the markets.
Well, let's talk about the private markets, because for most of this cycle, that's been a huge source of yield for investors out there. I'm wondering if they still see that as a source of yield given the rising rates, or if they also see it potentially maybe as a defensive hedge.
No, it's a great point, Romaine, and I think that a lot of attention has been placed on the yield advantage of privates, which is certainly true. But I think maybe what's less talked about is just how much the economy is changing. I mean, since the GFC, the banks, with all of their additional regulation, really have not been able to lend into the middle market the way they used to. They've gotten out of a lot of the project finance businesses, commercial financing, ABL financing. And basically, investors such as ourselves are now really stepping in and becoming the dominant force of that. So private credit is one of our largest and most growing asset class. Real estate the same way, because the banks have not been participating. And that's a big driver of the growth you're seeing.
That's a big driver of the growth. Do interest rates get in the way of that?
Interest rates will, I think, slow some of the growth, but no, I don't think it's going to derail the fundamental shift we've had to private markets. And we see many of our clients actually increasing their allocations to private markets at the expense of public.
Overall, when people talk about alternatives, and obviously that fits into the private market, but is that a broader universe than maybe the way we talk about it?
Alternatives certainly is, and I think you have to talk about private equity as part of that. I think you have to talk about real estate and private credit. And those are really the big stools, all of which have been growing quite significantly over the last decade, and we think will continue to expand.